David, we're delighted to have you here. And to start, just tell us, how did you get into private equity?
I would say I took a relatively traditional path. It was maybe a little atraditional back 25 years ago. It's hard to believe it was 25 years ago. I was at DLJ, as Judy mentioned, in investment banking, and then Drexel Burnham went bankrupt, moved out to Los Angeles to work with a big group of investment bankers that came from Drexel's LA office to DLJ. And one thing led to another, and I joined a very young startup firm called Apollo. I was there for 10 years. I really grew up at Apollo in the 90s here in our Los Angeles office, and really very fortunate to have done that. That's really where I cut my teeth in the private equity business.
Understood. Tell us a little bit about how you interact with investors. When you've got investors who supply you with funds, and then how do you interact with that side? And then we'll go back to the companies.
Sure. I'm just smiling. We actually, just so everyone knows, there's some pages. I don't go anywhere without slides. I do go to the dinner table with my family without slides, but coming here, I decided to come with some slides. So if you check, go to, on each table. If you go to page 8. I'm smiling a little bit when you ask that question, because the degree of complexity interacting with institutional investors around the globe, so it's page 8, folks, has only increased. There has been, again, over the couple of decades that I've been doing this, a significant number of newer types of institutions that have gone into the business of investing in alternative assets. That has really accelerated over the last, call it 5 to 10 years, driven by the low interest rate environment that we find ourselves in today. So we are seeing any number of different sovereign wealth funds, insurance companies, public pension funds, private pension funds, corporate pension funds, endowments, foundations, increasing their allocation to alternative assets, as well as entering alternative assets. Alternative assets being assets that are uncorrelated or less correlated to liquid equity and fixed income markets. And so you can see here, we literally have 539 institutional investors that we deal with, and we have 30-ish people in investor relations and marketing. But at the end of the day, the folks that do give us money want to see the people who are investing it. And so we have taken from day one, when we started Ares about 12 years ago as an independent company, we have taken a very transparent, down-to-earth, humble, fully disclosing kind of approach with our investors. And despite technology and the pace at which the world moves today, this is still a relationship business. And so when we have problems, I think one of the most important thing that we do with our investors is communicate those issues when they arise. Hopefully we don't have too many, and we haven't, thankfully, knock on wood, but that's a really important element.
Well, now, you haven't gotten the money. How do you get the acquisitions in the portfolio?
So one of the things that's happened in private equity, again, over 20, 25 years, I like to say that when I got started in the business, you made money on the buy. It was a reasonably inefficient market. There were not a lot of players, in particular in some of the things that we do, such as distress for control, which I know we're going to talk a little bit about, buying good businesses with bad balance sheets. So the market has become, just if you listen to Judy's comments about the amount of dry powder that's in the private equity market today, it is awash in capital. And there's really not a home for $1 trillion of dry powder. So that does drive the value of assets up, makes for a much more efficient market. And to go to market, a successful private equity shop has to have an edge, has to have an advantage. Our main advantage, is not our only advantage by any stretch, is the fact that we manage $85 billion of capital. We do it in a very coordinated way across 4 different asset classes that are related to one another. And so we literally see everything that we could invest in And we're able to see a very wide funnel of opportunities and make very few investments, because we do have the 800 employees that Judy referred, and many of them are investors in our fund, even though they don't work in private equity. And so they're thinking about us, and that's really our advantage in the market, is our platform.
Now, energy's been in the news a lot last year. How's that affected what you've been doing?
So I have some slides on that, actually. Thanks for the...
How curious.
Yeah, how curious. We did coordinate. So if you go to... I'm going to actually make some comments on energy and what it's telling us about the future of the distress cycle as well. So if you look at page 5, so Saudi Arabia basically precipitated a real correction in the oil markets in late November. We have several $billion of our $86 billion that are invested or exposed to energy. We are relatively experienced investors in energy, but by no means domain experts, but I would say that we really understand the energy markets. So what was so interesting about what happened in the next few slides, slides 5, slide 6, 7, these are Credit Agricole slides that I borrowed. They show the dark line is oil. And so you can see that, you know, we began a fairly precipitous slide downward in the price of oil. And what happened was that the high yield or leveraged loan markets that are about 17% of the energy market, there's a $3 trillion leveraged loan high yield market, again, 17% of which is in the energy or energy related businesses, bonds started to trade down. What's so fascinating, and I've never seen this before, it is a result of regulation, and it is a result of an active central banks across the world that have pumped tons of liquidity into the system. We literally took an elevator ride down from the 100 context in oil to the 40 context. And while that was happening, right around $60, $70 a barrel of oil, high yield bonds actually dipped to their low point. And so you can see that on all the slides, except for the bad companies, which are on slide 7, that are over-levered and not great assets. The point in me telling you all this is that intermediaries, market makers in all types of securities, because of the Volcker rule, because of Dodd-Frank and related types of regulation across the globe, are no longer in the proprietary trading business. And so they're truly making a market in all securities that are less liquid. So the stock market would be something a little bit different. As a result, when things correct, as did happen in oil and energy, the bond market dropped more quickly and actually ended up recovering because there was no breaks, there were no speed bumps available where Goldman or JP Morgan or Morgan Stanley was taking a prop position in a bond that was getting sold. So all that is a interesting foreshadowing of the coming distress cycle. When it happens, it's going to happen violently, and we are going to see 30, 40, 50-point drops in debt securities, and we're going to be able to buy companies, and I'm not wishing this to happen. I mean, it's not good for the world.
Well, you are if you're raising a distressed fund. You've been talking about
but I don't love the violence, I mean, you know, if you will. But volatility is here, and it is here to stay, and we see that across every asset class that we invest in and that others invest in, even stuff that we don't. And those that are smart and nimble and have the funds and the committed capital to take advantage of that volatility will make extra money, extra alpha.
And I take it that the anticipation of that bond market drop is what we hear that you're thinking about a distressed fund.
So we, of our 86 billion, I would say 10-ish of that has some sort of distressed element in its mandate, either as a sole mandate or the flexibility to go into distressed. And we approach distress generally in 2 ways. One is more of a trading-oriented approach, where we think the market, exactly the dynamics I just described, where there's a supply-demand imbalance that's driving the market to price a security off of its intrinsic value. So we could be buying a bond that we think is worth par or worth 80 or 90, and the market's trading it at 60. We're not going to end up owning the company. We don't want to own the company, but we buy it at 60 because we think we're going to make excess return relative to the risk we're taking. That's one approach, and that's done in our more tradable strategies. The other approach, which is where we, by the way, have raised this fund that you are referring to, the other approach is in our private equity business. What makes Ares a little bit different is we have a flexible capital approach. So Judy mentioned Neiman Marcus. We bought Neiman Marcus in a traditional auction run by Credit Suisse. We paid $6 billion for it. I like to refer to us as buying that company through the equity in a traditional private equity way. We're doing a lot of things to make that company better. Great company that we think had untapped potential. Guitar Center, also mentioned, we ended up buying Guitar Center through the debt. We own and control Guitar Center now. It was a Bain buyout done at the height of the buyout boom in late 2007. Great company, good company, bad balance sheet. We did a distressed for control strategy. Bought the entire capital structure at a very deep discount, ended up taking control. We ended up, in this case, replacing management, and we're building the business from a trough.
Oh, it's very interesting. We have students, very interested, many in private equity. What advice would you give them if you were thinking they're going to become first employees and then associates and then partners and perhaps in private equity funds? How do you maintain a really strong organization in private equity?
Well, for us, and I think this is true across every business that we touch, culture is number one. And so certainly if anyone in this room is assessing a job opportunity, I would say to me the single most important piece of advice I could give you is assess the culture of the organization that you're looking at and make sure there is a great fit. We have a very distinct culture. I almost refer to it as somewhat of a blue-collar culture within Ares. It's a very hard-working, very fast-moving, high sort of cerebral kind of approach to the world. It's not for everybody. We have very low turnover because we're incredibly selective about how we recruit and ultimately train folks. But the difference maker today in private equity, and I made mention of when I started 25 years ago, you could make money on the buy, you could find that mispriced company. Sure. Very, very hard to do today. The difference maker between those that perform in the top quartile of private equity managers and those that don't are people that know how to build businesses. Not necessarily getting in there and knowing what IT system to pick and grinding out cost, but being good stewards of businesses with a vision that's a differentiated vision to take a company to some place it hasn't gone before. And that could be an industry expertise that you have as an advantage to the market. That could be the platform that we've built, an $85 billion platform that gives us an advantage in the market. You need some sort of edge or angle. The market is just simply too efficient.
Yeah, and then let's talk just a little about the private equity industry. There's an industry in the United States, in particular Los Angeles. We're here in Los Angeles, and there is a concentration here of type. How does that fit into the national private equity markets, and where are the jobs?
Concentration of?
Private equity.
Of private equity.
Yeah,
here
private
in LA.
equity.
No problem. So LA is actually a reasonably small private equity community if you certainly look at the Bay Area or New York by comparison. I think there are emerging managers here in Los Angeles. A lot of the managers, interestingly, sort of trace their roots back to the Drexel, the 70s and 80s that are here in LA. So there are. I mentioned how I got into private equity. It was it's a bit traditional now when viewed with hindsight. At the time, it was not very common because private equity wasn't so proliferated. But today, I think you have to think creatively and entrepreneurially about getting into a private equity job. It's not necessarily because of what I just said, having an advantage or an industry knowledge, maybe going to work at a company in a strategic planning department of Disney or what have you. We've seen a lot of folks with actual industry expertise making the leap over. It's not just people who did 2 years of analyst investment banking, went to business school, and then go into private equity. So there's many different ways, but if you're interested in private equity, I really do believe that you need to develop skills on how to build businesses with a vision.
Before you enter private equity.
I think if you can break, any way you could break in, you should break in.
Do it.
Yeah. You know, if you're entrepreneurial at heart.
That's a fabulous lead-in to questions from students. What kind of questions have you got from a master?
What rough percentage would the entrepreneurial component be to success / breaking into the private equity field? I would say that the analytical capabilities that you get at an investment bank are generally table stakes. You need to have them. It's the difference maker between a good private equity investment professional that may be limited in their ultimate, ability to grow in the career in the profession, versus someone who's great, is this entrepreneurial judgment, strategic element. So I'm sure if you're taking finance courses and you know how to do an LBO model and you can do comp analysis and discounted cash flow, that's table stakes. You do need to be able to do that. As an associate or a vice president in a private equity shop, at least in ours. Ours is a little bit, I would say, more on the analytical end of the spectrum. There are others that aren't as analytical as us. Different ways to make money, lots of different ways to make money. So I say private equity is an apprentice business. It really is. And so I mentioned the culture piece, and that's true, I think, in any profession that you pick. But there is this judgment, entrepreneurial core that, some people have it innately and it needs to be molded. Some people, it's hard to learn. You have to have a gene. I do refer to it sometimes as a money-making gene. You have to have the money-making gene and know how to do the analysis and have the table stakes, as I mentioned, and then be around people that you share values with and can learn from and are committed to teaching you and mentoring you. That's so important. There are a lot of PE shops where my generation, I'm 47, sort of that generation in the shop, they've had some level of success or what have you, and they get fat and happy. And they're not working as hard and they're not around as much. And maybe some of the people in my shop don't want me around as much, but I think they do, and because it is hard to duplicate 25 years of experience in another way. Very tough.
But trying to understand your response,
Sure.
You're saying, I think you're saying, yes, it can be taught, which was the question.
It can, but
But that's an intellectual point, but then the emotion takes over to make a great entrepreneur.
Absolutely. You have to be willing to take that leap, and there is a judgment / leap of faith that you always have to take when you're pulling the trigger on an investment. You at some point you cannot control all risk factors and weight probabilities on all of them. You try, but I would say the mentoring piece and the commitment of an organization to grow their folks is really, really an important differentiator in the market, I would say, for us at least. That's why we don't lose people. Yeah, I was the first non-Drexel employee at Apollo, so there was a bit of an unknown there. The investment banking is an amazing career. So, but I really wanted to be in the more vertical business as opposed to the more horizontal business. Being a principal and building companies, you get much more vertical in the businesses. You own your mistakes for a very long time. So that's why trying to minimize your mistakes is such a key piece to a successful top quartile PE manager. It can be a black hole when you make mistakes. I've learned more from my mistakes than I have from my successes, so that is also important, that you do stub your toe, you do take that risk that we just talked about in that leap of faith. But banking was you collect a fee and you move on. Now, you build a relationship with that company, and you hopefully become their consigliere as their investment banker, as they're strategically looking at things to do with the business. But at the end of the day, you're not owning the rewards or the risk of the asset. And that's what I really wanted as a principal. So it drove me to Apollo. The very first thing we look at, and there are others that do different things and do it well, but the very first thing we look at is the asset, is the company, is the franchise value of the business. The financial engineering, the balance sheet, all that generally takes care of itself if you are buying an asset that is a good company, that could be a great company with some levers that we try to pull. And so there is a slide in here, I won't direct you to it, but there's a slide of how we deliver alpha, excess return, and it is, and again, we didn't have to do this in the 90s. You could just literally buy a business, lever it up, put up 20% of the capital structure in equity, and if it was a reasonably benign equity market, you were going to outperform, or macro environment, you're going to outperform. Today, that's not the case. You got to pick great assets that you can make some sort of difference with and have a differentiated vision. That's the first thing we look at. Well, there's too much capital everywhere. And you can thank our central bankers for that. I mean, we are awash in liquidity. And you can look at just our market as a microcosm of that in the leveraged loan and high yield market. The CLOs have been regulated and almost to death, but they're still around. And despite all that, you've seen our market grow from $1 trillion to $3 trillion over not that long a period of time, 6-7 years. And so that's both North America and Europe, leveraged loans and high yield bonds. So there's just too much capital, period. And so as a free markets guy, as a capitalist, I believe the music will stop. And when it stops, the reason I made the comment and showed you the sort of foreshadowing that energy has given us, it's going to be volatile. And there will be people that will lose a lot of money, and there will be people that make a lot of money.
Predictions as to who's going to win and who's going to lose, besides Aries?
Wow, how do I answer that question? I don't look in a crystal ball. I mean, I will say this, I don't know when. I do know the answer to if. There's just too many landmines that are out there geopolitically and otherwise. You could pick your poison. There's never been a list longer than we find ourselves in the world today that will trigger some sort of markets correction. Could happen in 15, could happen in 17. I'm pretty sure something will happen before 20. I just don't know when.
That's a good prediction.
Yeah. I think it's harder than ever to start a private equity firm. There's more regulation, there's more capital, there's more people that just are in the profession than ever before. That being said, I think firms that have a reason for being, to be a little bit repetitive, an edge or an advantage, and if it's an industry focus, if it's a diversified platform, if it's just there's something specific that gives them an advantage, there's plenty of capital to fund a first-time fund, just given the increasing allocations to alternatives in every investor asset, in every investor type out there. But it's not easy. It's a lot harder to start a firm today than it was 12 years ago when we did.
No more questions. David, we're very indebted to you for sharing your time and your knowledge with us for this whole group of students. And we thank you very much for being here with us today.